while ago show the consumer price index rose by 4.6% last month, in line with what the market expected. That's after rising by 4.8% in April. Joining me with his take is Freddie Mitchell. He's economist at the Efficient Group. Freddie, thanks for coming in today.
Pleasure.
4.6%, what the market was looking for. I'm not quite sure what your expectations were.
Well, our expectation is a bit higher. We were at 4.9, and we based this around some administered prices coming through that we expected to come through, and that didn't happen as of yet.
Do you think we could see these coming through in the months ahead, and this could be the trough for inflation?
Well, I guess so. We have the electricity price increase of 24.58% that's coming through, and also the wage increases that we saw that unions are negotiating that's well above inflation. So I guess that will have some effect somewhere along the line. We have to just keep an eye on the inflation figures and see where it comes out. And
of course, we've already started to see those Eskom figures coming through in the producer price index, and there was an expectation that from June it would start coming into the consumer prices. But there's also the second round effects, which would take a little bit longer.
Well, there's always, like you correctly said, there's a lead and lag effect in the PPI and CPI, and normally PPI leads consumer price index by some months, and we saw that PPI is coming up. We expected to see that CPI will soon follow trend, but that didn't really happen. So we will have to wait and see what's the lag. Is it 2 months? Is it 3 months? Is it 4 months? We'll have to wait and see, because we came from a 5.2 to a over 7 point that we expect for tomorrow, which is a market consensus. So we'll have to wait and see what's the total effect in producer price index, which will ultimately affect consumer price inflation.
Where would you expect the CPI to go from here? How long do you think we're going to stay in that target band?
Well, according to the Reserve Bank, they see that we will be in the target band, say from this year until the end of next year, that we won't move beyond or outside of the target range. But we'll have to wait and see if that materializes. The consensus in the market is 5.5, 5.6 roundabout for this year, and also continuing into next year. We expect it a bit higher, and we'll see if that comes true.
Of course, we had the Bureau for Economic Research yesterday putting out its inflation expectations survey, and there seems to be a bit of a disparity between where analysts and economists would expect inflation to be this year and where business and unions would expect it to be. And they're a little bit more bearish, but of course they are also the price setters in this economy, aren't they?
Absolutely. Like I said, when you ask analysts in the market and also economists, there will always be a disparity between the bearish and the bullish side of it. There's some economists that still reckon that we are having good inflation figures, and that won't last too long. That we maybe in the future will see inflation figures moving beyond 6 and be out of the target range and giving us the fright of another interest rate hike, but currently we do not see a hike or something, because we see inflation figures is coming down, which is quite nice, and that's overall good for economic performance.
You don't see a hike, but do you perhaps see another cut in interest rates?
That's really difficult. We were last month at a meeting with the Reserve Bank, and the government made it quite clear that inflation targeting is still a real priority, and that they would not back away from an interest rate hike if necessary.
Of course, we had those jobs numbers yesterday, 79,000 jobs lost in the formal non-agricultural sector in the first quarter of the year. We had the Finance Minister, Praveen Gordhan, today saying it was very disappointing that we are still losing these jobs despite the recovery that we are seeing. Do you think that could be maybe the straw that would push the Reserve Bank to cut interest rates again? It
could possibly be. We have to keep in mind that, like we say, we saw economic growth of 4.6%, and we had some good growth in the previous quarter, in the fourth quarter. But this growth is really jobless, and it's not really good, and there's no real demand within the economy at the moment. So basically, the economy is growing from a production side, but that production side does not translate into job creation or absorption of unemployment, which is not a really good thing, and that may be a straw on the back of Reserve Bank trying to cut interest rates.
How important is the current account deficit numbers that are going to come through tomorrow, as well as the rest of the Reserve Bank's quarterly bulletin for the first quarter? I mean, will that be key for where we see the economy going forward?
Absolutely. If you look at the current account, we saw that we're coming from very high figures, from around about 6 to around about 2.8%. Market consensus is about 3.2, which is quite low, up from the 2.8%. And that remains the Achilles heel of the South African economy. A too large current account deficit is not good. It surely does not help for investor confidence, and it may place some pressure on the rand in the long term.
Right at the beginning, you talked about some of the wage increases that we've seen coming through, and of course, Eskom workers are threatening to go on strike if they don't get a wage increase of 15%. They've brought that down from 18%. Of course, Eskom offering 8%. How do you see these wage negotiations playing out, and what is the impact of that going to be on growth going forward, and also on our inflation?
It will most definitely have an effect on the inflation within the economy. It's difficult to determine exactly how it will transpire into the whole system and the first to third round effects, but it's difficult to say when all the unions negotiate for price or wage increases beyond 3 times the normal inflation level. That certainly will push up inflation from a wage level, and that will most definitely be felt throughout the economy as people pass on price effects from one to another in the economy.
And of course, the rand outlook is also very important, I presume, for inflation going forward from here. And we've got the rand trading around 750s, 760s. Would you see the rand maintaining these levels, or do you think that it could also weaken and threaten inflation going forward?
That's a real tricky question. It all depends on what the Central Bank of China is doing with the renminbi. If the renminbi is being appreciated, it will mean that most emerging currencies, including the rand, will also strengthen. I mean, we saw the rand was trading at 770 some point and 2 weeks ago, and we're now at 750, and we see it maintaining some strength within the couple of months, at least to the end of the year, at least.
Freddie, we have to leave it there. Thank you very much for your insights this afternoon.